Disclaimer: Reggie and Royal's analysis and insights are based upon data gathered by it from various sources believed to be reliable, complete and accurate. However, no guarantee is made by Reggie and Royal, or Vision Associates LLC as to the reliability, completeness and accuracy of the information so analyzed. Reggie and Royal is in the business of gathering information, analyzing it and disseminating the analysis for informational and educational purposes only. Reggie and Royal attempts to analyze trends, not make recommendations. All statements and expressions are the opinion of Reggie and Royal and are not meant to be investment advice or solicitation or recommendation to establish market positions. Our opinions are subject to change without notice. Reggie and Royal strongly advises readers to conduct thorough research relevant to decisions and verify facts from various independent sources. Copyright 2021 Vision Associates LLC. All rights reserved.
All right, so let's just jump right into this stack of reports about the global financial system.
Okay.
They paint a pretty intense picture, you know?
Yeah.
Almost like a patient in intensive care.
Okay.
Totally reliant on, life support.
Yeah.
And that life support is, it's the actions of these major central banks.
Right.
Like the Federal Reserve, the European Central Bank, and the Bank of Japan.
Yeah.
Our mission today is to really understand what these banks have been doing.
Okay.
And how it all affects you directly.
Got it.
And also what some of the potential consequences might be.
It's a striking analogy for sure.
Yeah, it is.
And these reports make a strong case.
Right.
We're talking about a truly unprecedented level of intervention in the markets.
Really?
Think about it.
Yeah.
Since 2020 alone, trillions of dollars have been pumped into the system.
That's almost unfathomable.
Yeah.
One of the reports mentioned that the Fed's balance sheet is nearly $9 trillion now.
It's incredible.
That's more than double what it was before the pandemic.
Yeah, it is. And what's even more startling
Right.
is that the Bank of Japan's holdings
Okay.
are larger than the entire Japanese economy.
Wow.
It's as if they're trying to single-handedly prop up the market.
So this kind of stimulus was meant to be a temporary fix. Right?
Yeah, a quick fix to stabilize things.
Right.
But what happens when the patient becomes dependent on that life support?
That's a great question.
Yeah.
And it leads us right to this next issue these reports highlight.
Okay.
Tapering.
Yeah.
The Fed is talking about slowly reducing those asset purchases.
Right?
But history shows that tapering can spook the markets and lead to a lot of turmoil.
You're absolutely right.
Yeah.
Back in 2018, the Fed attempted to taper.
Okay.
And the markets essentially threw a tantrum.
Wow.
Stocks plunged, and the Fed was forced to reverse course.
So it seems like even the slightest hint of withdrawing stimulus can trigger a strong negative reaction.
It appears that way.
So if no central bank has ever successfully managed a sustained tapering campaign, is it safe to say they've created a monster they can't control?
That's one way to put it.
Like
of course, we have to acknowledge the context here.
Yeah.
The pandemic, supply chain disruptions, and the conflict in Ukraine have created massive economic uncertainty.
Sure.
Central banks were under immense pressure to act.
Yeah.
But their actions may have painted them into a corner.
And we can't forget about inflation.
Right.
Which is at a level we haven't seen in decades.
Yeah, it's crazy.
Is this just transitory, like the Fed initially claimed?
Yeah.
Or are we facing something a lot more persistent?
That's the million-dollar question.
Yes.
The reports point to several factors fueling this inflation.
Okay.
The pandemic led to a surge in demand.
Okay.
As consumers flush with stimulus cash,
Right.
started spend.
But at the same time, supply chains got totally disrupted.
Exactly.
Causing shortages, pushing prices even higher.
Yeah.
And just as things were starting to settle down,
Yeah.
the conflict in Ukraine throws another wrench in the mix.
Right.
It's a perfect storm of inflationary pressure.
Exactly.
So this creates a difficult dilemma for central banks.
Yeah.
If they raise interest rates too quickly to combat inflation, they risk triggering a recession.
Right.
But if they do nothing and let inflation run rampant, purchasing power erodes, and the entire economy could be destabilized.
Yep. It's a tightrope walk.
Yes.
With no easy answers.
It sounds like we're in for a bumpy ride either way.
Yeah.
But you mentioned something earlier
Okay.
that I want to unpack a bit further.
Sure.
the concept of real interest rates.
It's a crucial concept to grasp,
Got it.
especially in this environment.
Yeah.
The real interest rate
Mm-hmm.
is essentially the interest rate you earn on your savings
Okay.
minus the rate of inflation.
So if inflation is higher than the interest you're earning,
Yeah.
your money is actually losing value over time.
That's a sobering thought.
It is.
Even if you're technically earning interest,
Right.
inflation can eat away at your savings,
Yeah.
leaving you worse off.
And what's fascinating is that real interest rates have been declining for decades.
They have.
This has some significant implications for economic growth
Yeah.
and investment,
Uh-huh.
particularly for you as an individual investor.
Right.
One of the reports mentions a paper presented at a recent economic conference
Okay.
that links declining real interest rates to rising inequality.
It's interesting.
It's a connection I hadn't considered before.
Yeah, it is a complex relationship.
Okay.
But the basic idea
Yeah.
is that as real interest rates fall, borrowing money becomes cheaper.
Okay.
This primarily benefits those who already have assets
Got it.
and investments,
Okay.
allowing them to leverage their wealth
Right.
and potentially increase their gains.
So the rich get richer. Yeah.
Yeah.
While those who rely on savings or
Mhm.
fixed incomes
Right.
see their purchasing power eroded by inflation.
It's true.
That doesn't sound like a very sustainable situation.
It does raise concerns
Yeah.
about the impact of central bank policies
Okay.
on wealth distribution.
Right.
This isn't just some abstract economic theory.
Yeah.
It has very real consequences for everyone.
We've covered a lot of ground.
We have.
Stimulus overload,
Yeah.
the challenges of tapering,
Uh-huh.
the inflation conundrum,
Mm-hmm.
and now this issue of real interest rates and inequality.
Right. Right.
Is it safe to say there's a common thread running through all this?
The thread is interconnectedness.
Okay.
The actions of central banks intended to stabilize the financial system
Yeah.
have created a complex web of unintended consequences
Right.
that we're only beginning to understand.
Oh, wow. It's fascinating and a bit unsettling
Right.
to think about how interconnected everything is.
Yeah.
And it makes me wonder if we're seeing a repeat of history. These reports highlight that the market's reaction to tapering isn't just a recent thing.
Right.
They point to other periods
Okay.
where even the suggestion of tightening monetary policy has sent investors running for the hills.
Yeah, that's true.
One report focuses on the fall of 2018,
Okay.
pointing out a number of warning signs that were largely ignored.
Interesting.
So even before the pandemic hit,
Mm.
there were cracks in the system.
Well, there were definitely signs.
Okay.
Yeah.
What were some of the red flags people were overlooking?
One major concern was overvaluation in the market.
Overvaluation.
Remember the Buffett indicator we talked about?
Yeah, the ratio of total market capitalization to GDP.
Exactly, that
Yeah.
one. The one that suggests the market might be in extremely overvalued territory right now.
Right. I'm curious, where was it back in 2018?
It was high even then.
Okay.
It reached 145.8% in September of 2018.
Wow.
Not as extreme as today's levels,
Yeah.
but still a cause for concern.
Okay.
And what's particularly interesting is that every time this indicator has exceeded 114%
Right.
in the past 5 years, there have been negative consequences for the market shortly after.
So the warning signs were flashing, but people chose to ignore them. Do you think the bull market had something to do with that?
It's possible.
Okay.
When things are going well, it's easy to overlook potential risks.
Right.
But there were other red flags, too.
Okay, like what?
For instance, the yield curve had inverted,
Okay.
which has historically been a reliable predictor of recessions.
Can you remind me what an inverted yield curve means?
Of course.
Okay.
Essentially, it means that short-term interest rates
Okay.
are higher than long-term rates.
Okay.
Typically, investors demand a higher return
Mm-hmm.
for tying up their money for longer periods.
Right.
So when this situation is reversed,
Okay.
it suggests a lack of confidence
Got it.
in the long-term economic outlook.
And that's what was happening in 2018.
Yeah.
The bond market was signaling a potential recession.
Precise. In August of that year,
Okay.
the spread between the 2-year and 10-year Treasury yields inverted
Mm-hmm.
for the first time since June 2007,
Wow.
right before the last financial crisis.
So alarm bells should have been ringing.
They should have been.
Yeah. What was the market's reaction to these warning signs?
Well, we did see a significant market correction.
Okay.
In the fourth quarter of 2018,
Mm.
the S&P 500 dropped nearly 20% from its peak.
Wow.
The Fed, which had been gradually raising interest rates,
Right.
quickly reversed course
Okay.
and started cutting rates again.
It seems like they panicked a bit,
Yeah, it seems that.
seeing the markets tanking and reverting back to their old playbook
Yeah.
of easy money.
Yeah.
But this just reinforces the idea that they're trapped
Uh-huh.
in this cycle of stimulus and intervention, doesn't it?
It certainly raises questions about their ability to normalize monetary policy
Okay.
without causing a major market meltdown.
Yeah. And this brings us to another fascinating point raised in these reports. The possibility of the Fed buying stocks.
It's a possibility.
Wait, the Fed buying stocks. Isn't that a pretty radical idea?
It would be a significant departure from their traditional role.
Right.
But one of the reports argues
Okay.
that it's not as far-fetched as it might seem.
Mm-hmm.
They point out that the Fed has a history
Okay.
of implementing policies
Right.
they initially condemned.
So they might say one thing and then do the complete opposite.
It's happened before.
That wouldn't exactly inspire confidence in their decision-making, would it?
True.
Right.
But they would likely argue that their primary mandate
Yeah.
is to maintain financial stability.
Okay.
If that means taking unconventional steps,
Right.
they might feel compelled to do so.
Okay. So they could justify it
Yeah,
by saying they're providing liquidity to a market in distress.
that's their likely argument.
But wouldn't that create a slippery slope?
It could.
Where do you draw the line?
Right.
If the Fed starts propping up the stock market, what's to stop them from intervening in other markets?
That's a valid concern.
It feels like we'd be moving towards a centrally planned economy.
Right. It's important to remember
Okay.
that we're simply exploring the possibilities raised by these reports,
Right.
not endorsing any particular course of action.
Yeah.
However, it's not entirely unprecedented.
Okay.
The Bank of Japan, for instance,
Okay.
has been buying ETFs for over a decade.
Right. They seem to be ahead of the curve when it comes to central bank intervention.
Yeah.
Has that strategy been successful in boosting the Japanese economy?
That's debatable.
Really?
Japan has been stuck in a low-growth deflationary rut for years,
Wow.
despite the BOJ's efforts.
Okay.
Their experience serves as a cautionary tale,
Yeah.
demonstrating that simply throwing money at the problem doesn't always work.
All right.
Structural reforms and other measures are often needed
Okay.
to address deeper economic issues.
So if the Fed were to start buying stocks, it's not a guaranteed solution.
Right.
It might even create new problems.
Exactly.
Wow. It's a risky gamble
It is.
that highlights the challenging choices
Yeah.
facing central bankers
Yeah.
in this unprecedented environment.
Right.
They're trying to balance competing objectives,
Mm-hmm.
keeping inflation in check,
Mm.
supporting economic growth,
Yeah.
and maintaining financial stability.
Right.
As we've seen, these goals are often in conflict with one another.
They are.
It sounds like they're juggling chainsaws while riding a unicycle on a tightrope.
That's a vivid image.
It is.
But it captures the sense of precariousness we're facing.
Right.
The financial system relies heavily on confidence.
True.
And once that confidence erodes,
Mm.
things can unravel quickly.
So we have central banks potentially buying stocks,
Yeah.
inflation running hot,
Mm-hmm.
and the looming threat of another market correction.
Right.
It's a lot to take in.
It is understandable to feel overwhelmed by all this.
Yeah.
But it's not all doom and gloom.
Okay.
The reports also highlight some potentially positive developments. For example, there's evidence that inflation may have peaked.
That would be a welcome relief. What
Okay.
makes them think that?
There are a few factors.
Okay.
Some of the supply chain bottlenecks
Okay.
that were driving up prices
Right.
have begun to ease.
I've noticed that some things are getting a bit cheaper lately.
Okay.
Used cars, for example.
Exactly.
Yeah.
And while energy prices remain volatile,
Mm-hmm.
the initial shock from the conflict in Ukraine seems to be fading.
Okay. So there's a chance
Yeah.
that inflation will gradually come back down to earth
Yeah.
without the Fed having to slam on the brakes
Uh-huh.
and cause recession.
It's certainly a possibility,
That's good.
but it's important to remember
Yeah.
that inflation is a lagging indicator.
Okay.
It takes time for policy changes to
Mhm.
work their way through the economy.
Okay.
Even if inflation has peaked,
Right.
it could take months or even years
Wow.
for it to return to the Fed's target of 2%.
So we're not out of the woods yet. Not quite.
There are still many unknowns.
Yeah.
And the global economic outlook remains uncertain.
Right. But as we've been discussing,
Yeah.
understanding the forces at play and the historical context is essential for making informed decisions.
Absolutely.
Absolutely. Speaking of understanding,
Yeah.
These reports also delve into some fascinating academic research
Okay.
on the causes of declining real interest rates. I was surprised by some of the findings.
Oh, what stood out to you?
One report cites a paper
Okay.
presented at the Jackson Hole Economic Conference
Yeah.
that challenges the conventional wisdom
Okay.
about why real interest rates have been falling for decades.
Interesting.
You're referring to the paper that argues the main driver of this trend is not demographics,
Right.
as many economists have believed,
Yeah.
but rather rising inequality.
That's an interesting idea.
Yes, that's the one. It's a thought-provoking idea.
Yeah.
Could you explain how inequality leads to lower real interest rates?
It's a complex relationship, but the argument is that as wealth becomes more concentrated at the top, the wealthy tend to save
Okay.
a larger proportion of their income.
Right.
This creates a surplus of capital in the economy,
Right.
which can push down interest rates.
So the rich get richer,
Yeah.
and everyone else faces lower returns on their savings.
Yeah.
It doesn't seem like a very equitable outcome.
It does raise questions about the distributional effects of monetary policy.
Okay.
And it underscores the fact that economics isn't just about numbers.
Yeah.
It's about people
Right.
and how policies impact their lives.
Right. Yeah. It's definitely a lot to consider. We've talked about the potential for market instability, the risks of inflation, and the way central bank policies might be contributing to inequality. It paints a pretty complex picture of the global financial system,
Yeah.
one that's arguably at a crossroads. The old playbook of easy money and endless stimulus might not be sustainable.
Yeah.
But what does this all mean
Right.
for the average person who's just trying to navigate their own finances?
That's the question, isn't it?
It is. That's the question that's been on my mind throughout this whole deep dive. Are there any takeaways for someone who's not a high-flying financier?
I think the most important takeaway is awareness. Understanding the forces at play,
Right.
the potential risks and opportunities ahead. That's key. We've discussed the risk of inflation,
Right.
eroding your purchasing power,
Right.
and the possibility of market corrections if the Fed tightens monetary policy too aggressively.
Right. Not the most comforting thoughts.
Yeah.
But are there any silver linings
Yeah.
to this rather stormy economic cloud? Any opportunities we should be aware of?
Absolutely. Even in times of uncertainty, there are always opportunities.
Oh.
For example, if inflation remains a concern,
Right.
investing in assets that tend to hedge against inflation,
Okay.
like commodities or real estate,
Right.
could be a strategic move.
So diversify your investments
Yeah.
and consider options that are more resistant to inflation. Don't just stash all your cash under the mattress, right?
That's right. That's a good way to lose money.
Yeah. And as we've emphasized throughout this deep dive,
Yeah.
knowledge is power.
Absolutely.
The more you understand about the economy and the financial system, the better equipped you'll be to make sound financial decisions.
For sure.
This deep dive has definitely been a learning experience for me.
Good.
It's given me a lot to think about, and perhaps a few sleepless nights as well.
Hopefully not too many sleepless nights.
Yeah, hopefully.
Oh.
But it is important to stay informed
It is.
and engaged.
Yeah,
These are complex issues with no easy answers.
that's for sure.
Which brings us back to that thought-provoking question you posed at the beginning.
Okay.
What happens when the next big crisis hits?
Yeah.
If central banks have already used their most powerful tools,
Right.
what options are left?
That's the big question.
It is.
It might require us to rethink the role of central banks
Okay.
and maybe place a greater emphasis on fiscal policy and structural reforms
Okay.
to address these underlying economic challenges.
So it seems like we're headed for some potentially turbulent times.
Yeah, it's possible.
But are there any reasons to be optimistic?
Well, as we've seen throughout history, humans are incredibly resilient and innovative.
Right.
Challenges often lead to creative solutions
Yeah.
and new ways of thinking.
Okay.
The key is to remain adaptable, informed,
Yeah,
and proactive.
I like that. Well said.
Yeah.
I think this deep dive has given us a solid foundation
Good.
to navigate whatever challenges come our way.
I agree.
It's been a fascinating and insightful conversation.
Yeah.
Thanks for joining me.
The pleasure was all mine. It's always rewarding to delve into these complex issues and explore different perspectives.
And to all our listeners out there,
Yes.
stay curious, stay informed, and most importantly, stay engaged. The future of the global financial system depends on it. Until next time.
Great advice.